Well, on the economic survey projects GDP growth for FY25 between 6.5% to 7%, with risk evenly balanced. The survey also noted that the real GDP is now near pre-pandemic levels. Timsy Jaipuria lists down all the key highlights.
Well, the second economic survey, to be precise, tabled by Chief Economic Advisor V. Anantha Nageshwaran, actually says that when it comes to the GDP growth, the survey projects 6.5 to 7% growth number for the current fiscal. It also says that the real GDP is close to the pre-pandemic levels, which is quite healthy for the country. He also says in the survey that the inflation more or less remains a comfortable position for the country. But when it comes to inflation targeting, he has suggested that it is worth exploring to see that the targeting can be done without including food inflation numbers. The survey also calls for private sector to now take the baton, and I quote, take the baton on capital expenditure. A lot of capex has been happening from the public sector, that is from the states and the center, and now private sector is something that needs to take the baton and do more capital expenditure. It also says that when it comes to the FDI, that is where a silver lining is, that FDI from China can help increase India's participation in the global supply chain. Also taking cues from the warnings given by RBI and SEBI, the survey also cautions on the speculative trading that is happening in the FNO side in the capital markets, and that is something that the survey has cautioned on. And last but not the least, on the agriculture side, the survey says that that could be a survivor, and that could actually lead to further boost in the economy on the domestic side, because still 80% of the population is occupied in agriculture, and a lot of green areas and green pastures are there, which can be converted into better employment opportunities, better earnings for those employment in this sector. Let's see what cues does the budget pick up from this economic survey. Back to you.
Indeed, Timsy, thanks a lot for that.